All right, just get set up here. There we go. Hey, this is Virtual Metcalf, and specifically, I'm sending this out to you to answer your Q&A. But one of the reasons why I'm recording it is you all asked some great questions. And so not only will I be sharing this with other agents that we work with to help them get trained, but also be able to share it with other clients in the future. So thank you for your great questions. I'm going to start at the top of your list and just work down. And then again, any other questions you have, feel free to shoot me a message, or we can set up another person-to-person meeting and see if we can make sure that you really understand how this works. So part of what I'm going to do is explain what an infinite banking policy is and what it isn't briefly. And so what I mean by that, what it is and what it isn't is we do infinite banking with a life insurance policy. It is a life insurance contract. One of the major differences is we don't design it. We don't write it with the intention of it just being death benefit. And I know that you're aware of this, but because of that, and we'll get to some of your questions here, but because we are engineering this policy for you to be able to use it as a banking strategy, the priorities are different than they normally are if I was just an insurance agent writing you a life insurance policy. If I were just writing you a life insurance policy, we would be talking about how much death benefit do you want? We would be talking about, do you want this to be permanent, or you want this, until the house is paid off or the kids are out of college? Those are what I call the if questions. If I die before this happens, or if I die prior to this, then I would like this much to go to my beneficiaries. So the if question, it can be answered by a term policy. I rarely sell term policies. I do blend term with the banking policies, and we'll get further into that strategy down the road. So then the second part of just selling life insurance would be when someone says when, not if, but when. When I die, this is what I want to happen. So that's a whole life question, because we all know that we're going to die. And so that's the type of policy we use in those cases. Now with infinite banking, what we are doing is we are structuring a policy individually, engineering it based on your cash flow, your available cash. We're fitting this into your economy because we want to structure it in a way that it doesn't impact your lifestyle, how you live on a day-to-day basis, in a negative way. So there has to be money that you can use to fund the policy. How much do you, and that's one of the questions, how much do you need to fund the policy? How much you have to put into the cash value? Basically, what are my premiums and what other monies do I need to pay to get into the policy? So we're going to talk about all of that. But as we talk about it, I just want you to understand the difference. We are not typically, unless someone says to me, I want to do infinite banking and I want $5 million in death benefit. So then we start with that premise that the minimum death benefit is going to be $5 million. And then based on how the policy works, that death benefit is going to grow. I know we've talked about what type of policies we use, and we'll get into that as well. So let's just start at the top question in work 3. How does the infinite banking work? What is the process? So how does it work? Well, I'm going to give you the overview here. We set up a policy, and then we start that policy. Sometimes we start it and there's a large sum of cash. Someone's got a $20,000 CD that's matured, or $50,000 sitting in their bank, or $750,000 that is just basically liquid in cash. And so when we set up the policy, and once it's issued, when you make excuse me